This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anybody else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes or Apple Podcast, type in Old Dog, spelled D-A-W-G, find our podcast and subscribe. Well, we've got a great show for you today. I'm real excited about it. As you know, we're very, very interested in multifamily investing, and both from the passive and the active side of things. We have someone here that is a local expert. When I say local, a Southern California person here that also is very active in that space. Her name is Ellie Perlman. She's a real estate investment who owns multifamily properties across the U.S. Ellie is the founder and CEO of Blue Lake Capital, a real estate investing firm specializing in multifamily acquisition and management. At Blue Lake Capital, Ellie helps investors grow their wealth by investing alongside her in large multifamily deals. Ellie leads a mentoring program called Ready to Scale, where she coaches people to become multifamily syndicators by building and scaling a syndication business. She started her career as a commercial real estate lawyer, leading real estate transactions for Israel's largest real estate company. Later, she transitioned to a property manager role and oversaw properties worth over $100 million. Ellie holds masters in law and an MBA from M.I.T. Sloan School of Management. She is a Forbes author and a real estate investing podcast host. In her spare time, Ellie enjoys working out, driving sports cars, skiing black diamonds, and investing in startups. Well, Ellie, welcome to the Old Dogs REI Network.
Hey, Bill. It's really great to be here today. Thank you so much for having me.
Well, we sometimes let people in that aren't old dogs here, every now and then, because, we can learn new tricks from anybody. So, but it sounds like you've got a great background, and I'm real excited to, just have you share your story. You've got a great story. Our audience is all about, who the person is, that we're talking with. So I'd love for you just to share your story and how you, eventually ended up in this crazy real estate space that we're in.
Yeah, absolutely. So actually, my story starts back in Israel, and I was born to a pretty poor family and had to take care of my kids because my parents couldn't really take care of us. My mom was sick. And I found myself at the age of 11 cleaning synagogues just to help my parents, get by and have some pocket money. And so that shaped, this whole experience growing in that way when you're the only poor kid in the neighborhood and all the other kids make sure to remind you of that fact. That kind of, shaped my, my reality and also my desire, my burning desire to take care of myself financially, not to be in the same situation. And that desire pushed me to become a lawyer. And I said, hey, I'm going to be a lawyer. I'm going to secure my, my financial, my future basically. And I really liked real estate. Always have. And the reason was because I remember growing up and thinking, what can I do to kind of shift and move away from where I was financially, where I was in society at that point, which is in a pretty low place. And I understood that education was the key. And I also saw other people, the wealthiest people in Israel and in the world, they all owned real estate. And I said, I'm going to become a lawyer because I only had my brains. I didn't have any money to buy real estate. And that's how I'm going to get into real estate. And that's what happened. I joined I worked really hard. I got into law school and I joined the real estate department of a really big law firm in Israel. And that's how I was exposed to real estate. That was the first time that I got a little bit of a taste of what real estate is all about.
That's awesome. And did you start investing while you were in Israel still?
No, I didn't have any money to invest.
Ah.
So even as a lawyer, I was not making enough to save and invest in real estate. And like many people, I was under the impression that I had to have a lot of money to buy real estate because who were the people that owned real estate? The way that I saw it, only rich people, and I was not rich yet. So I was working very hard as a lawyer, and I thought I'm going to make my fortune by starting a law firm at some point and growing my wealth this way. And things changed because that was very close to 2007, and then the recession hit, and it hit pretty hard, and we felt it obviously. And so that was my first taste of a recession, and it made me a very conservative investor because I saw what being not conservative, what basically over leveraging and being too confident can do to you, because there's no proof against recession. Nobody is resistant 100%. And that was a very, very interesting, experience and lesson. And I was lucky not to be an investor at that point, but I also didn't have enough money to invest at that point.
Did you have real estate clients that were impacted pretty heavily by the recession?
Yeah, absolutely. I was working with the largest developer in Israel at the time, and all projects were just stopped. They were developing huge, multifamily properties in Europe. They were developing offices, and they basically did everything. And they were so confident that before the loan was approved, their MO was to start developing and start, putting a lot of money, basically investing their own money in the deal before the loan was even approved, because it was so clear to them and to us at that point that they would get the loan. And so they lost a lot of money there because all the funding dried up in one day. We couldn't get any answer from any of the banks. Nobody was willing to tell us what was happening because nobody really knew. And by the time we understood what was happening, it was too late. And our investors, they lost a lot of money.
Wow. Well, at some point, you made the step across the sea here to the U.S.
Yeah.
And when did that happen in your career? Were things changing a lot in the dynamics of the company you're working at, or do you just wanted to just move to the U.S.? Maybe give a little background behind there.
Yeah, sure. So at that point, after the recession was over, and things started to calm down, I actually realized that I was on the wrong side of the table, that I wanted to be my clients and find deals and find lands and develop, properties and buy properties. And I realized that that would be the way to scale and really build wealth, and not build wealth based on how many hours I work. So if I don't work, I don't get paid. There's no income. But if I buy a property, doesn't matter what I do, tenants are still paying me rents. And that realization kind of shifted my mindset. And so I quit my job as a lawyer, and I wanted to be closer to the business side of real estate. I didn't understand how I could buy real estate at that point, but I wanted to know how it operates. And I became a property manager. And for 4 years, that's what I did. I was just managing tenants' relations, and I was taking care of projects to improve the properties. And at some point after 4 years, I said, okay, I understand the legal aspects of real estate. I understand the operations side. I want to learn how to start a business because that would be the next step for me to start a real estate company. And that's when I basically made the move. And I said, if I'm going to go, I believe that America, presents more opportunities for me. And that's when at that point I started looking into business schools. That's why I transitioned here to the US, and I, ended up at MIT and got an MBA degree. And shortly after, I started investing in real estate, and I'm actually implementing everything, all the tools that I have, the legal knowledge and experience, the operational, aspect of my career, as well as the business side. And I never looked back. It's been a very, very fun ride so far.
What was your first purchase as an investor?
So, as an investor, my first purchase was actually a multifamily property. I didn't start buying single family homes because I ran the numbers and I saw that in order to scale and get to where I want to get, it will take me hundreds, if not thousands, of transactions every year, and it was not sustainable. Because I'm always starting with the end. Where do I want to be in 50 years and 30 years from now? And then I reverse engineer it and work my way back to know, okay, this is what I need to do in the next year. So in 20, 30 years, I'm going to get to a certain point. So I skipped single family homes. It was too much work for one door. And again, this is just this is my perspective and how I see things. Doesn't mean that it's not a good investment, just it's not the right type of investment for me because I'm looking to scale. So the first investment was, as a syndicator, was actually a multifamily property in Fort Worth, which is right outside of Dallas. It was a 2001 building in a very, very good area. And that was the first property I bought as a syndicator.
How many doors was that property?
That was close to 400 doors.
Wow, for your first purchase, that's pretty aggressive.
Yeah,
That's
yeah.
wow.
Yeah,
Um,
well, Bill, I didn't do it on my own. It was it was a team effort. I partnered with other, syndicators at that time, and together we were buying a bigger building than what we could have done, individually. And that's the thing. It was not for me, the bigger size was not scary. To buy, 12 or 20 units, that was more work for me than to buy 400 units with someone else that we can basically share the responsibilities. So it's always a team sport. It's always a team effort on every deal.
and where were you living at the time that you invested?
I was in Santa Monica at that
Okay, so
time.
you're in Santa
Hmm. Oh,
Monica, so you're
hmm.
investing out of state. Now, how did you talk about this network? Can you talk a little bit about that process? Is how did you start to connect with other syndicators?
Yeah, absolutely. So I think the first year, even before I started Blue Lake Capital, I networked everywhere. So I went to all the largest conferences for syndicators, and pretty quickly I learned where the quality crowd is and where the more experienced syndicators are. And but I started to go to those events, and then at some point you see the same people over and over. You connect, you have a call, you have dinner, and they connect you to other people. So within a year, most of my world and my inner circle was basically syndicators and passive investors, because I went to the places where they were socializing, living, professionally, exchanging ideas, and that's the number one advice I give people who want to become syndicators. You can't become a successful syndicator just behind a desk in your office or home. You have to be where we are, because we're partnering with people that we like and trust. And where do we meet them? We have to see them face to face, and that's going to those events. So I was flying to Denver, I was flying um, to New York, I was flying to Dallas, I was flying all across the US. And I spend money on hotels and car rentals and airplane tickets, because I wanted to be where syndicators are, and it paid off. So that's one part of networking. There's also, a great website. I'm not affiliated with them, but they're called Syndicators Are Bigger Pockets. So I also spend time there, and then I see it's mainly to meet, passive investors. But that's one way of networking with people who are interested in real estate. So that combination was very, very helpful for me.
And did you ever connect with a coach or any kind of a training organization that might be specialized in that area as well?
Yeah, absolutely. I like to collect degrees. So I have 3 degrees, and I don't know. Probably I'm going to stop here, but I like education and I like to be informed, and I think that's a very, very big part of it. Yeah, I got a mentor. I paid someone to teach me how to do what he does, and it's you can definitely do it without paying a syndicator, but I think for me, I saw two things. One, the speed at which I can develop my career and my company, which would have been probably slower. Um, and if I didn't have someone experienced by my side to guide me through it. And the second part was just avoiding making mistakes. One mistake in real estate can cost me a lot more than what I was paying for coaching. So I just thought it's not different than my law degree and my MBA degree. I pay to become smarter. I pay to gain more knowledge, and it helped me before. It got me to where I was before I started Blue Lake, and I didn't see any reason to try and figure things out on my own, especially since, as a syndicator, we work with investors, and it's not only my money that is on the line, it's other people's money. And so I wanted to make sure that I was doing the right thing, and growing faster.
So the folks that you work together with as either co-sponsors or GPs, these were people that were more experienced. They have been through other deals. So on your first deal, you partnered with those that had that
Yeah.
experience base, which is great. Did
Yeah.
the coach connect you also with some key alliances or partners early on as well?
Oh, absolutely. And that's also the power of working with coaches, because they're a few steps obviously ahead of you. So their entire world is also surrounded by investors, passive, active, lenders. They know everybody in the industry. And so a big bonus was basically connecting with their network. And that's the same thing, as a coach today. I offer the same thing. So with my students, I basically open up my network to them. And so people that normally would not connect with them because they don't know them, or they usually work with more experienced investors, that's kind of the shortcut that you can get by hiring a coach.
Great, great. Now, were you from the beginning, let's say for this first deal, were you actively looking to acquire? So you were hunting down markets, hunting down properties, or did you have a different role at that stage?
Yeah, so I was looking for properties from day one. That was, I was focused on capital raise, but also on the acquisition side. And there are many ways to basically, when you're just starting, there are many ways to partner with others. So if you find what you're good at, if you find what makes you tick, what you're passionate about, you can always add value to anybody. Doesn't matter how experienced they are, doesn't matter how big their company is and how sophisticated or experienced they are. There's always some pain point that you can tap into. So if someone, needs more help with underwriting, and you're an excellent underwriter because you worked for Marcus and Millichap as an underwriter for 3 years, this is a way for you to, to kind of get in the game. If you know people with capital, because you're, let's say, 65 years old, and you've done well for yourself, and others in your circle are in the same position, then perhaps you can partner with someone and help, with bringing investors, and you can both form a company where you're the partner that is responsible for the capital, and your other partner is responsible for bringing the deals. And then every deal you do together, you know what the other partner is doing, and you know what your role is. So it really depends on what your strengths are and what you're interested in. There's so many ways to get involved, and really depends on, your own path, your experience, where you live, who you surround yourself with. You just need to find that niche, and sometimes it takes time, and sometimes some people have multiple talents and multiple aspects that they can bring to the table. So they just need to find the right partner that together basically they can form a very solid, partnership.
That's great. Well, that first deal, I would imagine, would have been pretty intense because one, you've got probably a significant raise on your hands with the 400 units. Like you mentioned, when you're dealing with investors, you're dealing with other people's money, and you need to be very conscientious and also aware of the SEC regulations and all the other factors that come into play when you're syndicating. How did that first raise go for you? Were you a significant part of it, or were the other partners more active? How did that happen for the first deal?
So it was a combination of both. And I have to say that because I was speaking with investors way before I had my first deal, it really helped. I see some investors that when they start raising money only when they have a deal, they think, we have enough time. I don't have a deal right now. What am I going to talk to investors about? But that's a mistake, because there are three factors in every raise. When you're just starting to engage investors, if this is the first time you're doing syndication and you're new to this game, it's going to take time for people to digest that this is what you do. They're used to see you in a certain role, and now you're doing this. And so if it's the first time that they hear from you that you're doing this, most odds they're not going to invest with you, because people need time to process the change. That's one thing. The second thing that I've noticed, because people basically said, but you're a lawyer and you were at MIT, you're doing investing, that it took time for people to process the change. The second thing is that some people still don't know how syndication works, what to expect. So you need to educate them. And when you have a deal, you don't have time to do to take care of the education part. You want to focus on the deal. And the third part is, do they like the deal itself? And are they even interested in real estate to begin with? And so you can take care of most of it before you have a deal. When I started engaging with investors, it was 6 to 8 months before I had the deal, and it was good because it gave enough time for people to understand that I've made that shift. The second thing, many of them didn't know what a syndication was, so that time was helpful for me to answer questions, to send them links to articles, to videos, so they understood over time what it was, and I had to give them time for the information to sink. And some of the people that I thought would be interested in real estate were not, so I knew, or didn't have money to invest. So I knew that when I had a deal, I knew exactly who I should go back to, and not spend my time, trying to show a deal or an opportunity to someone who didn't have an interest in investing in real estate at all, or didn't have the money to do it. So the main thing they were focused on is, do I like the deal? Does it make sense to me? And that made everything a lot smoother. So when I had the first deal, that made everything a lot easier, because I was already raising money, months before I had the deal.
Now, do you also have funds that you maybe create a fund where you can have those dollars readily available when you do get a deal?
No, so we work on a deal by deal basis. Every time we have a deal, we basically present it to investors. And the reason why I don't do a fund is because, if the market changes, when you have a fund, you basically say the fund is going to invest in anything that has X% cash on cash and Y% IRR. And then the money can sit there for months before you find a deal. And then what happens if the market shifts? And now you're talking about X minus one cash on cash and minus one IRR, then right now the fund cannot find a deal that fits that criteria, because there has been some changes. So I'm very careful about, being transparent and explaining to investors that right now, 2-3 years ago, we could find 18% IRR deals all the time. At some point, it was 15%. And so if I had a fund that was looking for 18% IRR, I wouldn't be able to find a deal after a certain point in time. So I want to give everyone the flexibility to look at a deal and to see if they like it or not, and make a decision based on the deal, on the merits of the deal. So we at this moment we don't have a fund structure.
Gotcha. And this deal, the first one was, do you remember what year roughly that was? The 400 units?
Yeah, that was 2018.
Okay, gotcha. And then
Hmm.
since then, you've added quite a few onto that, it sounds
Yeah.
like. Has your team expanded since that time too, or is it still sort of the initial team that you started with?
Yeah, my team has expanded because we were looking into other markets as well. But we still keep a our team is very small. Overhead is one of the most expensive line items in the P&L of every company, usually. And so we don't you don't need a lot of people to run, a real estate investment firm, because a property management company is the property management aspect we're outsourcing at this point. At some point, we're probably gonna buy a company or start it in-house. So all the day-to-day operation, what takes, a lot of overhead, that basically is outsourced to a third-party company that's their specialty. We work with companies that, manage 50, 60,000 units. And so they're good at what they do. They know how to do the property management aspect, and we're overseeing them. So I feel like we have a marketing team, an investor relations team, and an acquisition and asset management team. So all three teams are working together. And we've definitely, grew since the first deal. First, it was just a few of us, and then from there we grew. And we're going to continue growing as we keep, buying more deals.
Right. And what markets are you in currently?
So right now we're in Texas, Florida, and Georgia. And I like to diversify because I don't like to be in one place. So if there are any shifts in the market, it's going to affect one market probably more than others. So I don't want to put all my eggs in one basket. Within those markets, we don't invest in all cities. So we're basically focused on Atlanta, MSA, DFW, and then Jacksonville, Orlando, and Tampa. These are our five submarkets that we're focused on. So we don't go to markets that have, small population or kind of remote, even though on paper returns can look very tempting and very good. I tend to basically center my my investments around highly, where you have population growth and I just want to have demand for my properties. And that's why I like to be around large cities where you have more, you have an influx of people that coming in. So demand is increasing for all of our properties.
Great. As far as the market in general, I know in 2018 it was a little bit different than it is today. Are you still very focused on multifamily, and you're not looking at any other asset classes, or what's sort of your strategy there?
Yeah, so I really like multifamily. This is something that I know and understand. It's our, bread and butter. I think especially, when you see volatility in the market, I believe that there's no asset class that is recession proof, but some of them are more recession resistant than others. And I definitely believe that multifamily is one of them. People always need a place to stay, but businesses are going out of business. And so retail and office are going to get hit in a recession more than multifamily. Hotels and the entertainment industry are going to get hit more than multifamily. So I think we're probably going to feel it, but not as much. And within multifamily, I like to be in B and C assets. So, and mainly B, which means properties that were basically established, were built in the 80s and the 90s, early 2000. But so I don't like to buy properties that are too old in the 60s and 50s, because they have a lot of deferred maintenance and their expenses are usually very high. On the other hand, I don't like to buy the high-end Class A buildings, because usually in a recession, their vacancies tend to increase because they're at the top of the market. And tenants are usually moving out and transitioning out of those beautiful buildings to nice buildings that are, maybe there's $400, $500, $600 gap in rent. This is where people are going to go, and this is where we are positioned. So I like multifamily, class B and C. That's our strategy, and we usually like value add. So like to moderate value add. We're buying in strong locations, and we're renovating the units and improving the exteriors as well, so we can justify a rent increase of $100, $150, $200. And that's our main strategy. And that's how mainly we make money in real estate, and especially in multifamily. I'm very bullish on multifamily. And I think it's a great investment. I think it's going to continue being a very, very solid investment, even in a recession.
Sure, I agree with you. Well, you've been very deliberate in your focus, which has been great. I mean, you've got the strong legal background, you've got the business background, you've been in property management. I mean, you've got, seems like all the right stuff to be able to be where you are right now. But even with all that and the coaching, we tend to make mistakes here and there. And are there any mistakes you'd like to share with us, or a mistake that occurred with you as you were learning this whole area, that something you've really learned from, and could be also of value to our listeners who are also looking at doing similar things as you?
Yeah, absolutely. I don't think there's one investor that is mistake free, and if there is one, I would like to meet him or her. I can share two mistakes: one from a syndicator's point of view, and one from a passive investor's point of view. So, from a syndicator's point of view, one mistake that I've done was calculating exactly how much equity I need to raise and sticking to it. And what happens is that some people, they have something that comes up last minute, and they say, "We're sorry, we can't invest anymore," and then you're left with 50 or 100K that you're missing right before closing. And so I learned from that, and I always raise about 15 to 20% more than I think I need. And it's first come, first serve. So if once you sign the agreement, the PPM, and you wire the funds, you secured your place. But if you haven't done it yet, then there's always people that we're overfunded on all of our deals. So there are always people that are waiting to get into the deal and invest. And so, but learning to basically keep the investment funding, the funding round open, and increase by 15 to 20%, just in case someone is, changing their mind last minute. You want to have that flexibility. You don't want to try and get 50 or 100 or $200,000, in the last minute. That's not a good place to be. So that's one mistake that I can share, that I've changed that since then. And I'm thinking, as a passive investor, I think one mistake is, and I'm investing in all my deals as a passive investor, and I'm also looking at other syndicators, and I'm also investing with other syndicators as a passive investor. I think one mistake is that I actually see others do, but I have to say that I also do it a little bit, is that I focus on the cash flow sometimes a bit too much, and not focus on the strength and the reputation of the sponsor. Sometimes it's better to get 6 or 7% cash on cash with a very, very strong, reputable company slash syndicator than to get a 9 or 10% cash on cash with someone who's less experienced. And I made a mistake of not investing passively with a very strong operator, because I thought the cash on cash was not significant enough, and turned out to be a very good deal that I missed. On the other hand, I know some of my investors that have invested with less experienced syndicators because they like the 10% cash on cash on paper, but in reality, they didn't make much money. They barely saw any distributions over a year. So I think that's kind of one mistake that I've been making as a passive investor, and I see others make. Don't only focus on, sometimes it's better to get, a reasonable 6 to 7. It's still nice, it's still okay. I mean, we're targeting 7 to 9%, but a 6% cash on cash return with a very solid operator is better than 10% or 9 with an operator that is not that experienced. So that's a mistake I see, being done a lot.
Great advice there. And regarding your holds, I know back when I first started investing in multifamily in 2016, there was the 3-year, 5-year, 7-year hold, and I see a lot of syndicators actually shifting that. Some that are buying for the long term. Whereabouts are you at in that regard?
So, it's interesting. I think right now we are sticking to 3 to 5 year hold. For the most part, it's going to be 5 years. I think moving forward, we're probably going to want to hold the properties for longer term. And what we do is, even if we're still looking at 4 to 5 year hold, we're going to take a loan with a much longer term, because I don't want to be pressured to sell the property in 5 years if it's the absolute wrong time to sell. If it's better to wait 1 more year, 6 more months, I want to have that flexibility. So we're still looking at 5 year hold for most of our investments, but then we're going to take 7 or 10 year loan. So if we need to hold it for a bit longer, we'll do it. And I see some sellers that have to sell, and when I know that their loan is due, I know that I have a little bit more, wiggle room when it comes to the price, because they have no choice. They have to accept a deal. They have to close the deal. Otherwise, their balloon payment, they have to pay the loan right away. So I haven't really shifted beyond the 3 to 5 year hold, and we're looking into it. It also depends on what our investors are interested in. And right now, most of our investors are interested in 3 to 5 year hold. They like the idea of selling in 5 years, taking the money and reinvesting in another deal.
How long are you looking at in terms of interest-only payments on those loans?
Interest-only payments, usually I would say, on average, 2 to 3 years. Sometimes we'll get 5 years, and sometimes we'll get only 1 year. I think for the most part, we're getting 3 years. And again, things can change, but usually it's around 3 years.
Great. And what would you say, success-wise, something that you've done that really just turned out much even better than you had anticipated? What could you share with us in that regard? A big success that you learned from as well.
Well, one of our deals, when we negotiated with a seller, occupancy was around 95 to 97%. And then, usually it takes about 2 to 3 months until you close. And less than a week before closing, when we were asking to see the updated financials, we realized that occupancy dropped to 82%. And that's a big hit. And it also meant that we were not supposed to get an agency debt, because in order to qualify for an agency loan, you have to be stabilized, meaning 90% occupied for at least 90% occupied for 90 days. And that was a very, very interesting situation to be in. So we got some credit based on the revenue loss, and we decided to close nevertheless, because we believe that the deal was very, very solid. And this is where working with a very experienced property management company, that's in those moments, this is where it's actually very important that you're not going to try and do it on your own, especially not if you're doing it out of state. But we were able to push occupancy to 90% and increase rents while doing so, above the projected rent increases within less than 2 months. And for me, I consider it as a success, because I didn't think we would be able to push it, as high and as fast. And it just, once we were there, we made sure that everyone knew that there's new management, that we're going to treat them well. We started cleaning the property right away. and renovating units. And when tenants saw how things are changing, I think that also, contributed to the increase in occupancy. So, what I've learned from that is that you can never foresee everything that is going to happen in real estate. You have to be prepared for anything and just, stay calm and not, freak out. 82% is a big deal. It is a big deal. We were able to convince the lender to keep the loan. And I think by managing this crisis, I'm definitely a stronger and a more, and a smarter investor. But in the moment when it feels like, I mean, you can freak out. I had some people in my team that were freaking out, but you have to lead people and basically say, hey, this is the situation. Now what do? We have option A, B, and C. And of course, I communicated that with investors and I said, hey, this is what's happening. This is how we're going to solve it. And I wanted to give investors the opportunity to say, you know what, I'm not interested. This is too much of a risk for me. And nobody did. Everyone trusted us. And we've been outperforming until today. So based on, our projections. So I think, what I learned from it is just staying calm, looking at the solution and focusing on the solution is more important. Just, take your emotions out of the situation as much as possible and just focus on the facts and the tools that you have. And I believe that plays a big role in success in any business.
Oh, yeah, definitely. Well, our audience are folks that are generally 50 years of age and older, although we have a lot of younger listeners. Our target audience really are those that are approaching retirement or already in retirement. So they're looking at real estate investing as a means to, there's a number of different reasons, but I think that two major reasons are, one, if there is a nest egg there, that they want to be able to maintain that nest egg for the long term. And there are a lot of unexpected expenses. People are living longer. There's assisted living expenses. There's all kinds of things that people don't anticipate in planning for their retirement. And so folks are, looking at that, at cash flow as a key element, but also, they're looking at, the possibility of doing it themselves and possibly building a legacy for their children and grandchildren that they could hand down to them, and build up something. So what kind of advice, I know that's kind of a mixed bag there, but what kind of advice would you have for those folks that are in that place right now, just from your experience? I mean, you started off, bam, had 400 units, so you just jumped right in. What would you have for those starting later in life here in terms of advice?
Well, I think it's no different than anyone else who starts in their 30s or 40s. And some of my colleagues and partners are in that age. I think they have, the benefit is that they usually have more resources so they can hire more help instead of running around and trying to do it all on their own, which is a mistake at any age. And I think they're more positioned to attract investors because most of their friends and family, around that age, or not most, but maybe a lot of them do have the funds to invest. So I would say it really depends on how big or small of a role they want to play in the syndication business. They can find themselves working harder than they've ever, been. And if they want to create that legacy and not, work from, 17 hours a day, there's a way to do it. But just as long as they understand what they're, going to and what's expecting them, because starting a syndication business is not easy. It's fun, it's rewarding, but it's also hard. So it means that, you have to know, even, at that age, what exactly do you want to do? Do you want to start a business and that means, working many hours, being under pressure sometimes? Or are you saying, you know what, I want to have a legacy business to my kids. I'm going to hire people to help me build this business. So I don't have to work, 28, 17, 13 hours a day. That's a choice. I have to tell that I hire, I have teams that work for me, but I also work, like crazy, but this is my decision. I can choose not to work as hard. So as long as they know what it takes to build the syndication business, and that's what I'm teaching in my coaching program, how, you have to choose how much involved you want to be, and if this is a lifestyle company or is it going to be a big company, and then how are you going to position your business, how are you going to build processes and build a business, in a way that would allow you to position yourself exactly where you want to be, so you're not going to be sucked into the business creation and just lose control over your personal life and your family life.
Great advice. Well, speaking of growing companies and so forth, what's sort of what's the thing that's exciting you about your business and what's ahead and sort of what's your end game? I mean, how long you want to do this for? Do you have a certain goal in mind or what, I know there's a lot of questions there. So pick whichever one you want to answer.
Yeah, well, my goal is to grow the company to become a billion-dollar company by the time I'm 50 years old. So I have, about 13, 14 years to go. That's the end goal. And as I mentioned, I started with the end goal and I reverse engineered it to how, what I need to do today. That's the end goal. What excites me is basically buying properties and seeing how the operation improves. That for me, and how the NOI, the net operating income, increases. For me, that's everything. When I'm looking at the P&Ls, I'm looking at them, a lot, and every month we're analyzing them with the property management company. When I see a 10% increase in income, a 5% increase in income month over month, that's what gets me excited, because I see how, our plan is impacting that property, and it cannot be more tangible than this. When you actually see how it becomes, how you improve the looks and the feels of the property. These are the things that excite me, finding ways to improve the operations, finding creative ways to push, the income and push rents and increase the income, the profitability of the property, finding creative ways, new ways of doing it. For me, that's what excites me.
Oh, that's neat. Well, it sounds like you're definitely on. Sounds like you're on point here as you move forward, which is exciting. I know we've got at this point, at least in the time of the interview here, I mean, the economy is definitely very volatile. But like you said, I think it's one of the most solid asset classes you can be involved in, because everybody, like you said, needs a place to live. And so we may have to adjust rents. We may have to, tighten our belts. We may have to do some other things. But, there's going to always be a demand. So I think that's a good place to be. But, well, our time has been zipping by here really quickly, unfortunately, and I want to respect your time here too. And but we have this session in our interview process here. It's called Wrap It Up, where I ask you a series of real quick questions. You share quick answers that are resources that you've used that have been of value to you, that our listeners hopefully will also find of value as well. So if you are ready, we can go ahead and wrap it up.
All right, I'm ready, Bill.
Okay. Favorite real estate book?
I'm going to go with the ABCs of real estate investing. That's a part of Rich Dad, Poor Dad, books. I really enjoyed reading the book. When I started investing, it really gave me a lot, to think about. So I would go with that one.
That's great. Favorite general business book?
Favorite general business book is The One Thing by Gary Keller, and it teaches you how to focus on one thing in your business, and the one thing that without it, that by doing it, the one thing that by doing it, everything else is going to be unnecessary or easier. And I've implemented that in my business, and I do see results. So one of my favorite business books of all time.
Great book. How about most valuable website for success, other than your own, of course?
That's a good question. Let me think. I like to read Yardi Matrix because it provides a lot of free content, a lot of free reports.
Markets and stuff, yeah. About
multifamily markets across the U.S. So we get a lot of good information from that. That's one of my go-to websites, actually.
That's a good one. Yeah, I'm surprised more people don't recommend that. That's excellent. How about a favorite app that you use on a pretty regular basis?
One of my favorite apps. I actually like Zillow. When I visit properties, I like to use it and see what's the average household income and what's the average house price around me, and that gives me a good understanding of who lives in the area. So, and I like to use Zillow, for to see other factors about the population. Among others, we also use Scout Neighborhood and CityData.com. But this is one of my favorite apps.
That's great. How about a favorite quote?
Favorite quote by Warren Buffett that said, he basically said, be fearful when others are greedy and be greedy when others are fearful.
Good one. If something happened cataclysmic here, let's say, and you lost all of your assets, everything that you've worked so hard for, and all you're left with is $1,000 in cash in your hand, what would you do with that $1,000 to rebuild your real estate investing business?
Pay a salary to my employee that can help me find the next deal.
Great.
Yep.
So it wouldn't be a very long salary though for $1,000.
Yes, there are ways to create it. I could pay him by the hour, and we can create a very basic pay where once we close the deal, he's going to get a very, very fat bonus to compensate him for going months with a very minimal salary.
There you go. That's great.
But there are always ways. There's always a way to solve a crisis or a problem. Always a way. So that's what I would do with my last $1,000.
Yeah, that's great. That's great, Ellie. Wow. Well, I'm sure there's a lot of people listening that would like to find out more about what you do, whether it's your coaching program or maybe some of the projects you guys are doing where you're looking for investors and so forth. So, what's sort of the best way for folks to reach you?
Absolutely. So you can Google my name, Ellie Perlman, and Ellie is ELLIE. You can also go to my website, ellieperlman.com, in one word. And if you go there, you can actually download a free document that will basically, going to discuss the 5 key components that every investor must examine in every deal. You can go to the resources page. It's Ellie Perlman /resources. And there's a lot of free resources out there, a lot of guides that you can download, a lot of spreadsheets that you can use. So, I put out, a lot of good content, if I may say, because I'm working with my team very hard on, to do it, but a lot of free content that you can find basically on my website. And there's also information about my mentoring program on the website.
Excellent. Well, we have a tradition here on the Old Dogs REI Network, and all of our guests get to close out our show with their best old hound dog howl.
Oh, how does that work?
Okay. Yeah. So, we're called the Old Dogs, so we're, we try to just wrap it up with our guests giving us their best old, it doesn't have to be a hound dog. It could be any kind of a dog you want, but just your best dog howl, to close us out.
Dog howl. I don't think I've ever done it on a show. That's interesting. Okay.
Well, we're ready anytime you are.
When I'm ready. Okay. Can you give me an example of the most favorite, howls?
No, that would be cheating. See, we have our Golden Howl Awards, and for really good howls, you could actually win the coveted, prestigious Golden Howl Award. So, if I gave you any clues, it wouldn't be fair to the others that have howled before you, like Robert Kiyosaki.
He did that. So just a dog howl,
just a dog howl.
Interesting. Okay, I'm gonna give it a shot.
All right.
Ooh, I guess. I don't know.
That's good. Hey, I'll tell you, that was good. That was not bad. That was fine.
All right. That was a first for me. See, like in real estate, there's always a first time for everything.
That's right.
just be prepared to be surprised. You definitely surprised me. So that's a good one, Bill.
Well, Jen, we're supposed to prep you for that one. I thought you guys would be practicing all week on this one. I
Yeah. Well, just have a deal to close, but yeah, I should have made time for this.
It's okay. Hey, we'll just have to have you back, so now you know what to expect.
Absolutely.
Well, it's really been a real pleasure, Ellie. Thank you so much for coming on.
Thank you, Bill, for having me. I had a blast, and I hope that I added value to your listeners.
Oh, definitely. And I also want to thank all our old dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Please note, everything we presented and that Ellie talked about today can be accessed in our very detailed show notes on the Old Dogs website at olddogsreinetwork.com/blog. And you're going to look for the episode featuring Ellie Perlman. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.